You know, every trader faces that same exact question, right? Is this a dip I should be buying? Or is this the start of something much worse? Well, telling the difference really comes down to one thing: understanding market structure. And today, we're going to break down one of the most powerful and most misunderstood tools for measuring that structure: Fibonacci. This quote from the legendary trader Paul Tudor Jones, it just perfectly captures the professional mindset. It's never about guessing where the market's going to go. It's about knowing exactly what your risk is if you're wrong. And the number one place traders get caught is by misjudging a pullback. That's why the pros don't guess, they measure. So here's what we've got on tap for this explainer. First, we'll cover what Fibonacci really is. Then we'll look at how to project the next move. After that, and this is huge, we'll go through the common mistakes that just cost traders so much money. Then, I'm going to show you how to supercharge this tool with a concept called confluence, and we'll wrap it all up with a simple checklist you can start using right away.
All right, let's just get straight to it and bust the biggest myth right off the bat. Fibonacci levels, they're not magic, okay? There's no secret cosmic force moving the markets. It's actually a lot simpler than that.
Think of it like this. It's a measurement tool. That's it. The best way to picture it is as a measuring tape for your charts. We use these specific mathematical ratios to measure just one thing: how deep is a pullback compared to the last big move. That's all it does. It's not a crystal ball, it's a ruler for managing risk.
Now you'll probably notice that 50% level there. And what's really interesting is that it's not technically a Fibonacci ratio at all. But so many traders and algorithms watch it that it becomes this huge psychological point, kind of like a self-fulfilling prophecy. The real ratios, like the 38.2 and the 61.8 golden ratio, help us figure out how strong a trend is. A shallow pullback to the 38.2, that signals a really powerful trend. But a deep dive down toward that 78.6 level, that's a warning sign that the trend might be running out of gas.
And actually applying it is a pretty simple mechanical process. First, you just need to find a clear, obvious price move. We call that an impulse wave. Second, if you're in an uptrend, you connect your tool from the absolute bottom of that move, the swing low, all the way to the very top, the swing high. And the third and final step, you just sit back and watch how the price behaves when it gets to the levels the tool draws for you.
And this, right here, this is probably the single most important rule to remember. A Fibonacci level is not a prediction. It's a spotlight. It doesn't tell you what will happen, it just shines a light on a potential reaction zone, an area where the battle between buyers and sellers is probably going to heat up. Your job is just to watch that spot very, very closely.
So, okay, let's say the price is pulled back to a key level, and you see buyers are starting to step in. Awesome. The next logical question is, where do we take our profits? Well, instead of just guessing, we can use another part of this tool: Fibonacci extensions.
See, extensions project potential targets based on the size of that original move we measured. Levels like the 1.272 and the 1.618 are watched by a massive number of traders, which makes them really common areas where people start taking profits. This gives you a logical, structured plan for your exit, which is always better than exiting a trade based on fear or greed.
And now we get to what I think is the most critical part of this whole explainer. Look, understanding the tool is one thing, but knowing how to avoid the common traps, well, that's what separates successful traders from the ones who get frustrated and give up. The first mistake is just plain overuse. New traders often get excited, and they draw Fibonacci grids on every single tiny wiggle on the chart. All this does is create a total mess of lines, and it leads to what we call analysis paralysis. The key is to be picky. Only draw them on the clear, significant moves that actually define the main trend you're looking at.
The second major error is ignoring context. Let me be really clear about this. Fibonacci is a trend-following tool, period. It's built to measure pullbacks inside a clear, established trend. If you try to use it when the market is just chopping back and forth sideways, those levels become meaningless. They'll just spit out one false signal after another. And finally, and this one is a biggie, never ever place a buy or sell order directly at a Fibonacci level and just hope for the best. Remember, it's just a zone of interest. It is not an entry signal by itself. The professional way to do it is to wait. Wait for the market to prove to you that the level is important by showing you some kind of confirmation.
So, what does confirmation actually look like on a chart? Well, it could be a classic reversal candlestick like a hammer or a bullish engulfing pattern. It might be a sudden spike in volume showing you that the big money is stepping in. You might even see a smaller chart pattern, like a double bottom, form right there on the level. Or you could spot something like a divergence with a momentum indicator. The point is, you need more evidence than just the line itself.
Which leads us perfectly into the concept that really unlocks the true power of this tool, confluence. This is where you go from looking at one thing at a time to building a complete multidimensional picture of the market. Confluence is just the idea that a single level becomes way more powerful when it lines up with other technical signals. So imagine a 61.8% retracement level that also happens to be a major support level from last month, and the 50-day moving average is sitting right there, and then you see a big bullish candle form. Suddenly, the probability of that zone holding just went up dramatically. You're stacking the odds in your favor.
All right, let's pull all these pieces together now. We can build this into a simple, practical checklist that you should run through every single time you're thinking about using this tool.
The key here is to use this as a filter. So, before you even draw your first line, just ask these questions. Is there a clear trend? Is the market structure still intact? If the answer is yes, okay, you can proceed. But if the market's just choppy, or if there's some big news event causing chaos, the tool stays in the toolbox. This kind of discipline, honestly, it's what separates the amateurs from the pros.
And that brings us right back around to our core philosophy. We really have to strip away all the hype and mystery. Fibonacci is not some magic formula that predicts the future. It's a measuring tape. It helps you measure risk, it helps you identify important areas on the chart, and it helps you create a structured plan.
So when you use it the right way as a measurement tool, it helps you define and manage your risk, which is, the #1 job of any trader. But what happens when it's used incorrectly? When it's seen as this all-knowing, predictive, magical tool? What does that create?
False confidence. And I'm telling you, that is one of the single most dangerous things in trading. Believing you know what's going to happen next just because the price touched a line on your chart, that is a recipe for disaster.
Thanks so much for watching. In our next explainer, we're going to build on this foundation. We'll take this Fibonacci framework, combine it with some powerful momentum tools, and we'll break down a real trade, step by step, so you can see exactly how all this theory meets reality. I'll see you then.